Skechers may not make headlines like Nike or Adidas, but quietly, it's been one of the best performing stocks in the retail space. With strong margins, global expansion, and steady demand, Skechers has built an impressive track record. But as the next earnings call approaches, investors are asking, is this the perfect moment to step in, or is a correction looming? In this video, we'll explore Skechers' recent momentum, dissect the fundamentals, and break down what to watch in the upcoming report. Could this be a buy before the breakout setup, or is Wall Street getting ahead of itself? Welcome to Stocks Telegraph, where we turn earnings reports and market headlines into smart, no-hype investing insight. If you're looking for real analysis that helps you make better stock decisions, hit that like button, subscribe to the channel, and ring the bell so you never miss an opportunity. Skechers recently surged after investment firm 3G Capital announced a $9.4 billion acquisition that would take the company private. The $63 per share buyout represented a 27.6% premium over the prior close, sending shares up nearly 25% in one day. While that's a strong vote of confidence, it came after a relatively sluggish start to the year. Prior to the deal, SKX was down about 8% year-to-date. Still, this spike puts the stock close to its 52-week high of $78.85 set earlier in January. Technically, the stock is showing bullish momentum, with a 32.99% monthly gain and strong volume to match. Investor sentiment is also shifting. The market seems to be positioning for further upside, especially as the earnings report nears. So the question remains, is Wall Street quietly loading up, or waiting for a clearer signal? Skechers has carved a unique lane in global retail. In 2024, the company reported record revenue of $8.97 billion, a 12.1% increase year over year. International markets accounted for roughly two-thirds of that total, with EMEA sales up 25% and Asia Pacific up 3%. The company operates more than 5,296 stores globally and continues to expand across markets like South Korea, Mexico, Greece, and India. Its direct-to-consumer strategy is also paying off, contributing to a 10.7% jump in revenue. On the product front, Skechers isn't chasing flashy trends. Instead, it's focused on innovation in comfort tech, like arch-fit insoles and hands-free slip-ins. Collaborations with brands like John Deere and endorsements from athletes in soccer and basketball have strengthened its brand identity across demographics. Put simply, Skechers isn't trying to be Nike, it's building its own durable, profitable lane. In a space dominated by high-profile players like Nike, Adidas, Puma, and Under Armour, Skechers has opted for a different approach, and it's working. Rather than competing for elite athletes, it focuses on mass-market consumers looking for affordability, comfort, and value. This strategy has helped Skechers secure a strong position as the third-largest footwear company by sales. It also delivers consistent profitability. Its 9.33% net margin outpaces several competitors. Skechers' pricing is accessible, but it doesn't come at the cost of efficiency. The company is lean, reinvesting wisely in tech and global expansion. And with half of revenue coming from overseas markets, Skechers is well diversified against domestic demand shifts. In short, while the giants battle for sneaker supremacy, Skechers is winning with a quieter but highly effective strategy. Skechers is set to report earnings on July 23, 2025, and there are a few key metrics investors should track. Last quarter, the company posted $2.41 billion in revenue, a 7.1% year-over-year increase, though slightly below analyst expectations of $2.43 billion. However, EPS came in at $1.34, beating the $1.17 consensus and highlighting strong cost control. Gross margin dipped slightly from 52.5% to 52%, largely due to pricing pressures. But inventory fell 7.6% to $1.77 billion, a positive sign for operational efficiency. International performance remains solid, with EMEA sales up 13%. The Asia-Pacific region saw a small decline of 0.6%, largely due to currency headwinds and local market challenges. Despite the numbers, Skechers withdrew its full-year 2025 guidance due to global uncertainty, especially trade policy risk. That adds some caution to the mix, but if they beat again on both the top and bottom lines, expect a major confidence boost. Skechers looks strong, but a few headwinds are worth watching. First, there's tariff pressure. With much of its manufacturing in Asia, increased U.S. tariffs on Chinese and Southeast Asian imports could raise costs and compress margins. Second, economic uncertainty is impacting global consumer demand, especially in regions like China, where Skechers saw a sharper decline. Foreign exchange fluctuations could also hurt results if the dollar strengthens further. Operating expenses are another area to monitor. They rose 12.1% in the first quarter of 2025, driven by higher wages, rent, and logistics costs. If those continue rising faster than sales, profitability could take a hit. Lastly, the company's withdrawal of full-year guidance suggests management is bracing for more volatility ahead, something investors shouldn't ignore. Analysts remain broadly bullish on SKX. Of 14 tracked by MarketBeat, 12 rated a buy and 2 say hold. The average 12-month target is $61.15, with high-end projections reaching $79. From a valuation standpoint, the stock trades at a forward PE of 16.81, relatively modest for a company with global reach and steady earnings. That puts it below some peers, suggesting the stock isn't overpriced even after the recent spike. Institutional investors also appear confident, with nearly 30% of shares held by large funds. That kind of backing usually indicates strong long-term conviction. So, is SKX still undervalued or already priced for perfection? The numbers lean toward more room to run, assuming execution holds steady. Skechers presents a compelling investment case as it approaches its next earnings report. The company has demonstrated consistent growth, with the first quarter 2025 revenues rising 7.1% year-over-year to $2.41 billion. Earnings per share increased slightly to $1.34 from $1.33 in the previous year. International sales, particularly in the Europe, Middle East, and Africa region, grew by 13%, contributing to 65% of total revenue. Analyst sentiment remains positive, with a consensus rating of moderate buy. The average 12-month price target is $69.62, suggesting potential upside from the current price of $61.39. However, investors should be mindful of potential risks, including increased operating expenses, which rose by 12.1% in the first quarter 2025, and uncertainties related to global trade policies. The company withdrew its full-year 2025 guidance due to these uncertainties, indicating potential volatility ahead. For long-term investors confident in Skechers' brand and global strategy, the current price may present a buying opportunity. Conversely, cautious investors might prefer to wait for the upcoming earnings report, scheduled for July 23, 2025, to gain more insight into the company's performance amid current challenges. Skechers may not be the flashiest stock, but its steady performance and global reach make it a noteworthy contender in the retail sector. The next earnings report could be a pivotal moment in determining its trajectory. Drop your take in the comments. Whether you're bullish, bearish, or somewhere in between, we want to hear from you. And if this breakdown helped you see the stock in a new light, hit that like button, share it with another investor, and subscribe to Stocks Telegraph for more no-hype stock insights every week. Thanks for watching, and we'll see you in the next one.